For thousands of years, gold has been more than a precious metal. It has been the silent force shaping empires. When its value rises sharply, history shows that powerful nations often face internal fractures, economic instability, and political turmoil. This pattern is not random. It's a repeating cycle recorded across civilizations. Rome suffered from gold scarcity and devaluation. Spain drowned in its own imported gold. The Ming Dynasty collapsed under monetary imbalance, and the British Empire fell as global gold flows shifted. Today, many analysts argue that the United States may be entering a similar trajectory. The story of gold is not about treasure, it is about power, inflation, trust, and the fragility of global systems. Understanding this cycle helps reveal whether the current American era is approaching a turning point. Gold has always been closely tied to monetary power. In ancient Rome, each coin represented not only wealth, but also political authority. As emperors diluted gold content to finance wars and public spending, the currency lost credibility. Hyperinflation emerged, trade declined, and social unrest spread. That moment became the first documented case of an empire collapsing due to poor monetary management. This pattern continues through history. When governments manipulate their gold reserves or lose control over their currency, people seek alternative stores of value. Gold's rising price is often not a cause of collapse, but a symptom, a warning signal that confidence in the system is fading. And once confidence erodes, restoring stability becomes nearly impossible. Spain's downfall offers another version of the gold paradox. When Spanish fleets flooded Europe with South American gold in the 16th century, the empire expected endless wealth. Instead, prices skyrocketed, wages stagnated, and the Spanish economy became dependent on plunder rather than production. Too much gold created the same crisis as too little. It destabilized markets and distorted national policy. Spain became a case study of resource curse economics, proving that wealth without structure is a path to collapse. As gold rose, social inequality deepened, and foreign powers exploited Spain's weaknesses. The Ming Dynasty illustrates another extreme. A collapsing empire not from excess gold, but from losing monetary stability altogether. During its final centuries, the dynasty shifted between paper money, silver, and gold, each transition creating chaos. Counterfeiting exploded, regional lords issued their own currencies, and trust in the imperial economy evaporated. As silver became the preferred medium of trade, global minds in the New World and Japan determined China's fate from thousands of miles away. When silver imports slowed, tax payments collapsed, armies went unpaid, and rebellions surged. The Ming example shows how a nation can lose sovereignty not through invasion, but through the breakdown of its monetary backbone, proving that without stable value, no political structure can survive for long. By the 19th century, the British Empire rose through mastery of global trade routes and the gold standard. London became the heart of world finance, and the pound sterling was considered as strong as the metal that backed it. But when industrial rivals emerged, Germany, the United States, and later Japan, the British financial system struggled to maintain fixed gold convertibility. Wars drained reserves, colonies demanded autonomy, and global trade shifted away from London. When Britain abandoned the gold standard twice in one century, it revealed the empire's declining influence. Gold's rising value in global markets signaled not prosperity for Britain, but the erosion of its role as the world's financial anchor. Across all these civilizations, a common pattern emerges. Gold's rise often reflects weakening institutions rather than strengthening economies. When citizens lose trust in government, they escape to hard assets. When inflation grows uncontrollable, gold becomes a shelter. When empires stretch beyond their capacity, gold reveals the imbalance. This cycle, trust breaking, currency weakening, gold rising has repeated with mathematical consistency. The metal itself is neutral. It neither destroys nor saves nations. Instead, it exposes the structural cracks that leaders refuse to see. Every empire believed it was unique, yet all followed the same trajectory. Today, the United States stands at a similar crossroads. Its dollar dominates global trade, just as Roman coins once dominated the Mediterranean and the pound dominated the 19th century world. Yet signs of stress are emerging. Record debt levels, declining global trust, geopolitical fragmentation, and central banks worldwide increasing their gold reserves. These shifts do not necessarily predict collapse, but they echo earlier transitions. When foreign nations hedge against the dollar, when markets question monetary discipline, the historical cycle of gold begins to move. The question is not whether the US will fall, it is whether it can adapt before the cycle matures. The Federal Reserve's challenge today mirrors the dilemmas of past empires. Maintain low rates, and inflation threatens stability. Raise rates, and debt burdens become unsustainable. Expand the money supply, and the dollar weakens. Restrict it, and economic growth slows. This delicate balance resembles Rome's debasement problems, Spain's inflationary spiral, Ming China's currency chaos, and Britain's gold standard rigidity. The US is not repeating history. It is navigating its newest version of an ancient puzzle. How to preserve monetary power when global trust is fracturing. Central banks worldwide are quietly shifting strategy. They are buying gold at the fastest pace in decades, reducing dependence on the US dollar. Nations like China, India, Russia, Turkey, and many in the Middle East are leading this movement. Such behavior mirrors historical eras when global power began shifting from one dominant empire to emerging alternatives. Gold buying is not a declaration of war. It is a signal that a new financial architecture is forming. When enough nations diversify away from the dollar, the system that supports American influence may face unprecedented pressure. If history repeats, the turning point for the US will come not with a dramatic collapse, but with a gradual erosion of privileges. The dollar may remain strong, yet slightly less dominant. International trade may diversify. Foreign nations may rely more on gold and regional currencies. Like Britain after World War II, the US might shift from absolute ruler to influential participant. Empires rarely disappear overnight. They transform, shrink, or decentralize. Gold's rise simply accelerates this transformation by exposing imbalances earlier. However, the US remains different from past empires in several ways. It has unparalleled military strength, technological dominance, and a culture of innovation. These factors may allow it to survive the gold cycle more gracefully. If the nation reforms its fiscal system, stabilizes its debt, and restores confidence, it could create a new economic model that blends digital assets, stable monetary policy, and global cooperation. Empires that adapt endure. Those that resist change fall. The US still has a window to shape its future if it chooses adaptation over arrogance. History teaches that gold is not the destroyer of empires, but the mirror that exposes their weaknesses. Rome, Spain, Ming China, and Britain all faced the same test and failed for different reasons. As the price of gold rises today, it reflects a world reconsidering its foundations. The US stands at a pivotal moment where it can either renew its system or repeat the cycles of the past. The next decade will determine whether the American order transforms, stabilizes, or fractures. Gold, as always, stands silently in the background, not as a conqueror, but as the world's oldest warning signal.